Fed's latest policy meeting, we need AI to figure that. Latest policy meeting is set to begin today. The futures right now are in the red. Look very similar to other mornings recently. For more on the markets, let's bring in Stephanie Link, Chief Investment Strategist, Portfolio Manager at Hightower Advisors, as well as a CNBC contributor. Which start with macro. You're not always comfortable there. You're sort of comfortable either place, but interesting piece that kind of aligns with some of your comments in the Journal today. Jerry Baker talking about, and I don't think he means that it's that we're past the point of worrying, but he says, have we dodged the tariff disaster? Brexit's results were less dire than opponents had warned. Something similar may be happening here. He goes on to say, look, it's way too soon to celebrate because the actual tariffs aren't in. But we heard the jobs number, Steph. Oh, it's going to be, this is huge. This is going to show that. And then all we did when it came in okay was, all right, it's next month is definitely the one to look at. I mean, we waited for Godot for 2 years, a couple of years ago, for a recession when the Fed was raising. That never came. I'm not saying the same thing's going to happen now, but you've pointed out that we went from oversold completely. Now we're almost overbought again.
Yeah. I mean, 3 weeks ago, we actually hit a 5-year low in the fear and greed index. It got to 4, Joe. 0 is the worst, and 100 is the most optimistic. We got to 4. During COVID, we got to 2. So we were very, very oversold. And we've rallied. We're up 13% since then. But a lot of it is because the earnings numbers have come in better than expected. Earnings growth is 13.3%. Revenues are growing 4%. I was actually pretty pleased with the guidance. I know there are a couple of industries that are struggling, but I do think that for the most part, we did get guidance, and I wasn't sure we were even going to. So a lot of this has to do with the fact of what you mentioned. I mean, the jobs number on Friday was really a pretty good report. Better jobs, lower inflation on the wage side. But we've also seen real final sales from purchasers, from domestic purchasers, was up 3%. What does that tell you in the GDP report? It strips away a lot of the unevenness in terms of inventories, the government spending, and that sort of thing. And so that rose 3%. That's pretty healthy. I'm not saying we're running 3% growth in the economy now, but I think we're much better than what was feared in terms of a recession. And by the way, last week we got really good income and spending numbers. Real spending was the best since January of 2023. Yes, we probably pulled through some tariff issues, pre-buying, but for the most part, the consumer's hanging in there, and that's because they have jobs.
Yeah. And you worry when you're not worried, and you're worried. I'm
worried.
You worry when you're not worried, so you're worried, so you're not worried.
I worry. Look, the market always climbs a wall of worry. We worry about something. There's so much to worry about.
I finally arrived at where you were. If you worry when you're not worried and you still are worried, then you're not worried because you are worried.
Well, I worry when I don't worry because that means I'm complacent.
I know. I totally understand what you're saying. And that GDP number gave the bears and Democrats reason to celebrate, but it really wasn't what it appeared to be necessarily. The other thing, Steph, I don't care why oil is at 50, wherever it is. It was, as low as 57. Maybe it's growth worries. Maybe it's, what the Saudis say. Whatever it is, it's both. But it's unbelievably great for inflation and inflation expectations.
Yes, absolutely. I know we're all worried about egg prices because they're still high, but they're coming down. But we're not complaining about a 13% drop in gasoline prices, right? That's certainly going to help the consumer. Inflation is coming down, Joe. And it's not where the Fed wants it to be at 2%, but 2.5%, 3%, certainly better than the 9% numbers we were seeing 2 years ago. So I think the consumer, again, they've got jobs, wages are running 3.5%, 4%, inflation's coming down, and that's why real spending was what it was in terms of last week's numbers, and very encouraging. It'll be really interesting, though, to hear the consumer discretionary companies when they report earnings, because that obviously will be the real tell, and that sector has gotten hammered this year, and actually over the last 2 years.
You had 9% cash in February. You're 2% today. You made 3 additions that you mentioned to us. Wells Fargo, PWR, and Meta, right?
Yeah. Well, look, Wells Fargo, I like the banks. I'm overweight the banks. Wells Fargo had a solid quarter. But what I like about it is that they're a self-help story. They are focusing on productivity, especially on the consumer side. They're working on gaining market share and trading in capital markets, in wealth management, in credit cards. And then, of course, you have the asset cap lift that's coming. And that will help in terms of earnings. I think something like 5% in terms of accretion to earnings. So that's your catalyst on Wells.
How about Quanta?
Quanta is all about electrification. We talked about it,
grid.
Right? I mean, we've been talking about it for a couple of years now. We're going to spend $4 trillion on electrification, and Quanta Services is certainly a beneficiary. We haven't spent money on the grid and upgrading the grid in over 50 years. So Quanta is in a really good position. They actually had probably the best quarter in that particular sector on that theme. And then Meta was the best of the Mag 7 earnings reports.
Of the MAGA. That's a MAGA stock now, not just a MAG stock, I think, with all the... Right.
I know. But you know what? We talk about AI and how, for a lot of the big technology companies, they haven't seen monetization yet. These guys, AI actually has helped their time spent on Facebook increased 7% because of AI and 6% on Instagram. So they are monetizing. That's why that stock is a buy. And the stock is still down 19% from its highs, trading at 17 times earnings. So I think you can still buy that one.